Hello, everybody, and once again, this is Dr. Majo Jacinto, and in this lecture, I would like to show you how to prepare financial statements. And what are the statements? It's the income statement, the statement of owner's equity, balance sheet, statement of cash, and the statement of cash flow. To get us started, I need to bring you back to what we completed in our first session when I demonstrated to you how to record business transactions using the accounting equation. If you're looking at this table right now, at the very bottom of this table, it's telling us what are the ending balances of the different accounts that we used throughout the month. So, for instance, our cash has an ending balance of X amount of dollars, our accounts receivable, our supplies, along with accounts payable, capital, the revenue sources, and the expenses. So all of that you are seeing at the bottom. They are the ones that are double lined as the ending balances. Now remember, we need this information. This is critical for us to be able to prepare the financial statements that we need. I just want to go over some pointers with you again as it pertains to recording transactions. When we were recording transactions in our first session, I showed you the relationship of every transaction that we were working on. For example, in the very first transaction was a deposit of cash. And then later on, we spent cash because we purchased a piece of property or furniture and equipment. What happened to the cash? Since we used cash, the cash is reduced. That is what I meant by building a story. These transactions do not exist independently, they are connected. And those relationships are what you need to continue to follow until you need to the end point, until you get to the end point or the month end where you now have the ability to prepare the reports. And always remember that whatever transaction it is that you are recording and you are classifying, make sure that the very simple equation that assets are always going to be equal to liabilities plus owner's equity. So the effect of that transaction should be a plus and a minus within the equation, which would make it equal. Always remember that the transaction must be equal. Now, as I said earlier, we are going to prepare financial statements. So, as a means of being able to communicate all of these business activities that took place during a certain period of time, now our obligation at the end of the day is to communicate this information. But how do we communicate them? We best communicate them by preparing what we refer to as financial statements. And in preparing financial statements, you need to prepare them in sequence. And I am saying this because it will make your life very easy if you follow the sequence. Each report builds upon one another. Let's start. The first statement that you want to prepare is the income statement, followed by the statement of owner's equity, the balance sheet, and then the statement of cash flows. So now, let me show you how to prepare an income statement. This is the first statement that we need to prepare. What is on your income statement? An income statement, otherwise known as a profit and loss statement, is a report that provides you with the information of the revenues, the total revenues of the company, and from there you subtract all the expenses incurred by the company. Where did this information come from? Once again, I take you to the very first page of this presentation where I showed you the ending balances or the summary of the transactions that were completed for the month of July. All of the revenues or the ending balance in the revenues and the ending balance in each of the expense categories are the items that we are actually reporting here. All of the items that you're seeing, like the service revenue being 21,000, for example, the salaries expense being 1,800, etc., etc., you can trace this right through the table that we put together that demonstrated and showed us what the ending balances are for the period. What's important about this report is knowing what is the profitability of the company at a given point in time. This is telling us as of July 31st that our revenues of 21,000 minus our expenses of 5,420 gives us a net income of 15,580. Now, I said earlier the sequence of preparing reports. This is the first report, and you need the net income to prepare the next report. The next report coming up. Now, we're talking about the statement of owner's equity. The statement of owner's equity tells us where the company is at. What is the company worth at the end of the period? Here, you start out with the original investment that was um, invested by the owner. And in this case, there was a $30,000 investment. As I said earlier, we wanted to prepare the income statement first because we need the net income of the company. The net income of the company here was 15,580, gathered from the previous report, which we are reporting here right now. And then from here, we are also subtracting the withdrawals. And at the end of the day, as of July 31st, what then is the capital balance or the owner's equity of the owner, Mary Smith? That number is 42,580. That is the new capital as of July 31st, or the end of the month. Once we have completed the owner's equity statement, then keep that number because you need that to prepare the next statement, which is the balance sheet. What is the balance sheet? The balance sheet brings you right back to the very same and original accounting equation that we've discussed: assets equals liabilities plus owner's equity. What are we listing on this balance sheet? We're listing all of the assets, the ending balances of all the assets, which once again came from the summary of transactions that we originally recorded. These are the ending balances of each and every type of asset that we have available, from cash, accounts receivable, supplies, and office equipment. The total number of our assets, according to our accounting equation, must equal our liabilities and capital. So take a look. Your liabilities is equal to 2250 in accounts payable. And the owner's equity, where did that owner's equity come from? That owner's equity came from the statement of owner's equity we prepared before. So this is the third financial statement that we need to prepare. And then as you can see, the ending balances of your assets and the liabilities and owner's equity are equal. And then finally, the last report that we need to prepare is the statement of cash flow. The statement of cash flow is really a statement that tells us what is the cash position of the company and where and how did this cash come about. In short, we are only interested in the cash flow of the operating activities, investing activities, and financing activities. We're not concerned about anything else but just the ins and outs of cash, the inflows and the outflows. This is just as important as the other statements, but the three basic statements, the income statement, the statement of owner's equity, and the balance sheet, are most important. I hope you learned something from this lesson. And once again, if you have any questions, feel free to contact me anytime. Take care and have a good one.